The Bank of England said on Wednesday that it would keep interest rates at 0.5% unless inflation threatened to get out of control or there was a danger to financial stability. Canadian Mark Carney, who took over from the long-serving Mervyn King as Bank of England governor, said bank rates will not be raised until unemployment fell. Bank of England policymakers said they stood ready to buy more government bonds if additional stimulus was needed and would not reverse existing purchases while unemployment was too high.
While the unemployment rate remains above 7%, the MPC stands ready to undertake further asset purchases if further stimulus is warranted. But until the unemployment threshold is reached, the MPC intends not to reduce the stock of asset purchases from the current £375 billion. Now, it's important to stress that forward guidance does not mean that the MPC is promising to keep interest rates low for a particular period of time. The path of bank rate and asset purchases will, as always, depend on economic conditions.
The Bank of England said that growth was likely to be weak by historical standards, even though economic recovery was taking hold and inflation was forecast to stay above its 2% target until the second half of 2015 based on market rate expectations. A growing number of major central banks are providing so-called forward guidance to help nurse their economies back to health after the damage of the financial crisis.